Hello everybody, this is Toni Turner and welcome to the market now as of Friday, February 17th at about 3 p.m. Eastern. Well, Goldman Sachs and Bank of America said today they expect the U.S. Federal Reserve to raise interest rates 3 more times this year, lifting their estimates after data pointed to persistent inflation and a resilient labor market. Well, if you go to the grocery store, you know that we have persistent inflation. Anyway, on that note, let's go on to 3 charts that will give us some insight into the week to come. First, as we always do, we're going to look at a daily chart of the S&P 500 SPDR, symbol SPY. This is the exchange-traded fund that closely follows our benchmark S&P 500 index. And we follow the SPY and keep an eye on it as traders, because during bull markets, 3 out of 5 stocks will follow the SPY higher, and in a bear market, 4 out of 5 stocks will follow it lower, so we use it as kind of a guide. Now today when I captured this chart, the SPY was trading at, right here, it was trading at $407.23. You can see that just today it fell below the 20-day moving average, the red line, which is coming in at $408 and change. Now, to remain in a bull market, the SPY technically needs to remain at least above these October lows, at least 20%. Right now, we're not quite there. We are up at this 407. The SPY is trading 14% below, above the SPY's October lows. When it gapped down here, it gapped down to open at $348. So we know that from these benchmark lows at $348, the benchmark started climbing. That was a big gap down, and then a big buy up, and it started climbing in a pretty nice uptrend here. It moved, climbed from the October lows all the way up through November, up over the 20-day and the 50-day, the green line, all the way up to these 2 highs up here. November and December, it punctured the 200-day moving average and moved up to these highs at 410. So the SPY moved up to the first high at 410, then some selling took over, and it moved back up to the second high right about at 410, and at this point it gapped up. Didn't get gapped down in October, it gapped up at the end of November here. It gapped up to 410 and then fell hard back down, so we're back down here in this 390 area. Then it dipped after it gapped up here. It gapped down and then kept falling in what we call a dumpster dive here, down to this zone here at 375. It kind of walked right below that 50-day moving average. It walked sideways or consolidated through the end of December and into the first week in January. And then we got a nice surprise, because it's always positive for the market if it moves up in January. That's usually a positive note for the year. It's not a guarantee, but it certainly many times says that, okay, it's going to be better this year type thing. At the end of January, right here, it climbed up. We can see where the 20-day crossed over the 50-day, crossed over the 200-day, the black line. This whole movement here of these moving averages getting back into place, getting back into the 20-day being the highest, the 50-day below that, and the 200-day below that. That's all positive, and this crossover of moving averages was a bullish note. So we know it climbed up to right up here on February 2nd. It climbed up to $418, which was certainly above the 410s back in December of 22. That was a good thing. We noted in the market now a couple of weeks ago that the 14-day RSI that you see down here on this screen, that the 14-day RSI had gotten overbought, and we noted that, and we said whenever that happens, it doesn't right away, it doesn't happen, but whenever the RSI gets overbought, meaning this line goes over the 70 line or bumps its head on it really hard, that can say that we might see a little selling in the next couple of weeks or so. Look left with me on this chart at August in 2022. Look how the RSI went up and over the 70 line. Look how overbought the SPY was, and sure enough, down it came. Now, we don't have to see, at this particular juncture, we're not going to probably see, fingers crossed, the same move down that we did in August, but I'm merely pointing out that when the RSI gets overbought, there's usually a little selling going on within, not right away sometimes, but within the next couple of weeks. It got overbought in November and those two highs right there, and then sold off a little bit. So it's just something we keep an eye on to give us a little guidance, this 14-day RSI. Okay, so now we can see again the SPY is trading currently at $407 and change. The next challenge the SPY has is to hold here. We're in this little uptrend. We've got a trend line here. It's pretty well drawn actually by the 20-day moving average. We have price support here at 400. We have moving average support coming in at 396.59 or 397 if you want to call it that. There's plenty of price and moving average support down here at right around 400 and just below it. So our next challenge here, the SPY, now that we're pretty much done with earnings season, is to see if this can hold and start and resume its climb again, or does it need to pull into a rest stop here and hang around the 50-day for a while. So you will know in the coming week which way it's going to go. Our second chart today is a daily chart of the Invesco QQQ, symbol QQQ. The Qs represents the top 100 non-financial companies by market capitalization in the NASDAQ stock market. And we're talking here about the big momentum stocks like Apple, Amazon, Microsoft, Alphabet, Tesla, that whole group. Now, when I captured this chart today, the QQQ, we're trading at $309. $300.09. Now, hold on a minute. Let me look at this really closely. No, we're off here a little. It's so close to the moving average, the 20-day moving average. The Qs is trading at $300.74, and the 20-day moving average is coming up underneath it at $300.09. So you can see the 20-day moving average here is kind of acting as support. And as we'll talk about in a minute, we also have price support here from this low here on back a little earlier here, like at the beginning of this week. So at any rate, what we do know here that trading at $300.74, the QQQ is trading about 17% above its lows back in October. And we want it trading 20% above for a bull market, but it's at 17% above the October 13 lows, and they came in at $254.26 when the market gapped down that day. Practically everything gapped down and then rallied. Now, we know that from these lows back here, the Qs really tried. It's hard, though, when interest rates are being raised, it's very hard on tech stocks to have higher interest rates. So it tried to rally into the end of the year here. It did move up off these lows that we just talked about at $254 up to the 50-day moving average. Couldn't do it. Made a higher low here at $260. So a higher low is always good. It means buyers are coming in sooner rather than waiting for whatever asset it is to come down to that prior low. So a higher low is always better. Came in here at 260, then rallied up above the 20-day moving average and the 50-day moving average, and then just decided to walk along pretty much sideways. and then rallied back up again up to about 300 here, but couldn't do it, and everybody took a dumpster dive in December, and so did the QQQ. Came back down to these lows of 260. And as we've said before, if you look at a longer term chart, say a monthly chart, you'll see that 260 has been support for the QQQ in the last couple of years. So it started rising right after this low here at about 260. It started rising the first week in January, which is a positive note. Made it up above the 20-day moving average and the 50-day moving average, and a very nice uptrend here. Kept moving up. A lot of people are saying it's time to buy tech stocks because they're so beaten down, and I get that. And then it made a pop on February 2nd and rose up to a high here at $313.68. Now that gap up was a pretty big deal, but it had to get filled. Many times gaps do have to get filled at some point, and this one did. So price popped up again on February 2nd to $313.68. Now we had talked a couple of weeks before, just like we did with the SPY, we talked about an overbought RSI, and we can see right here where the RSI rose above the 70 line on the scale, which means that when it pops above, we know that it can mean that within the next couple of weeks price is going to go lower. And I've been looking at this for, I don't know, 25 years, and it always pretty much seems to be the case. It doesn't mean it's going to do it tomorrow morning early, but it does mean that weakness may come in, at least in the short term, at whatever you're looking at. So it popped up and did that gap up, then started falling down, came back down here to this line here, back down to the 20-day moving average that we can see today. So we're sitting on price support right now, again, right around 297 from the lows of February 10th back here. We have more support. If we look down, we've got more support at the 200-day moving average coming in at about $290. So that's a good thing. We've got the 50-day moving average down here. They are inverted, but it's here, and that's coming in at $284 and change. So we have resistance here at 309. Right here, if price starts higher, we have resistance at 309 and at 318. So right now, the QQQ is deciding whether it wants to fish or cut bait, and we don't. Right now, it hasn't made a decision, but it certainly will during the coming week. So stay tuned on this one and watch those moving averages. Our final chart today is a chart of the daily chart of the Invesco Dynamic Food and Beverage ETF, the PBJ, aptly put there for that symbol. It has 31 holdings. Top holdings include Hershey, Kraft Heinz, Pepsi Company, excuse me, Keurig Dr. Pepper, I should say, and General Mills. Now, the PBJ made its all-time highs actually pretty recently in April of 2022. Excuse me, you can't see it on the chart. It did then make a more recent high here, not quite as high, but it made a more recent high December 1st of 2022 at about $48.54. So we can look back at this recent low back here, and we can see that we had a real quick double bottom come in on September and October, of 2022, of course, at about $42. So we had, it looked like what was moving nicely in July in a pretty stable, nice, although steep uptrend. RSI became overbought, see right there? The PBJ started down, came down to these lows down here at about $42. Very volatile move down. As you can see, when candles have much more price space between the highs and the lows. That is volatility, and it means the bulls and bears are fighting each other. Then it bounced in October off that second low and had a pretty violent uptrend here for a couple of weeks in October, then shot straight up, back up here to about 47 in the first part of November here. We had it come into 47. Then we had it make a consolidation here. We knew it had to break out one way or the other, and the PBJ chose to rise higher here and jump up to the highs here at 48.54 that we mentioned a while ago, December 1st high of 48.54. Then it kind of slipped back down again into the end of the year, then bounced up in January up to this price point here at about 46.75, fell back down, and now seems to be simmering down a little bit. It's walking along the 200-day moving average, and has been since the early to middle of January, walking along the 200-day moving average. Today it looks like it's breaking out, and the price when I captured this chart today is trading at $46.30, just above the 50-day moving average, which is coming in at $46.14. Now we have the 20-day below that, as you can see, at $45.77. The 200-day moving average has been acting as a support mechanism here for the PBJ, and that's coming in at $45.41. Just call it $45 if you like. So we've got this consolidation here. Now I've been keeping an eye on some other actual commodity stocks, and it looks like corn may pop, maybe wheat, some of those. So when I saw the PBJ going, I thought, I bet you this might have some room to run. This consolidation zone is providing a stop. I'm not interested if it falls below this zone. I'm not interested at all. So if in the coming week the PBJ can stay above the 200-day moving average, which is coming in at $45.41. Right now it's trading again at $46.30. So if the PBJ can stay above the 200-day, which is coming in at $45.41, I will add a small position to my trading portfolio. My initial stop is going to be under the 200-day at $44.90. Now, if and when the PBJ rises back to this December high, so if it rises up to $44, if it rises up and above $48.75 is the number I'm going to use to get in. If the PBJ can rise from here, and it may take it a while, if it can rise up and get above $48.75, I will add more shares to my portfolio, and of course by then I'm going to have a trailing stop. So you may want to keep an eye on the PBJ in the coming week. Now, if you'd like to become a more successful trader, this is the perfect time to check out my trader training programs. You can choose from 10 different online trainings, like our flagship 7 Steps to Successful Trading. Plus, you're going to find easy to learn strategies that target swing trading, trend trading, how to read charts, how to read charts, great for novices, 3 winning setups, also actually good for everybody. And the one I like right now, how to bottom fish like a pro, because this is a really ideal time to learn how to do that. So start the new year by learning how to elevate your trading skill set and increase your gains quickly and easily. To see all of my online training programs, simply go to the link on this screen right here, or easier still, just click on the orange button below. Until next week, keep green on your screen. I'm Toni Turner, and this is The Market Now.